is back again. I have Brad Gibb from Atlas Wealth Solutions. Say hi, Brad.
Hey guys, how you doing?
All right, we're going to do a talk which may not appeal to anyone or may appeal very strongly to a few. We're going to discuss risk management and how it applies to life insurance and real estate. Sometimes when I listen to the wrong libertarian podcast, or I get in a pessimistic mood, or I read Doug Casey's newsletter about everything's going to fall apart, I just want to buy a bottle of water and MREs and just wait for the collapse. But, then I wake up and I'm like, I have a lot of real estate to invest in. There's still a lot of good things out there. And it turns out life insurance, which I'm already doing, is a great hedge. So why don't you take it away, Brad?
Yeah, and then the point you made there, Jimmy, was really important. This discussion is for people who realize things could get really bad and probably are, but still want to participate in the economy as long as they can, right? So if you're to the point where you think the end of the world's tomorrow and I'm getting gold and guns and food and go to the mountains, then you can ignore all of this. But this is for those that want to continue, like I said, continue to provide value and invest, but want to be aware of the risks as they do that. Is that fair?
And even if these pessimistic things never happen, this is still a superior investing system.
Right?
Because we're going to show you how you can start cutting out the middlemen, and you can, if you operate on a cash flow, low time preference, long time horizon, this is the perfect way to invest. Even if the stock market keeps throwing up great numbers.
Yep, it's going to protect our downside while still allowing us to invest for the upside. Okay?
And control our investments.
Yep. Okay, so I'm going to draw a little diagram here for you. And we're just going to talk about risk in general for a minute, and then we'll kind of come back and apply it to this stuff. But in 2008, everybody heard about how dangerous derivatives were, and it seemed like this new concept that had just emerged. And it wasn't really, it had become commercialized, but this idea of derivatives has existed for a long, long time. Okay? So
any type of insurance is a derivative.
Well, anything that gets its value from a different underlying asset is a derivative. Okay? A mortgage is a...
I sell my tenant buyer is technically a derivative.
Yes, and a mortgage on a property is technically a derivative, right? Because the mortgage is only valuable such that the property is. So there's lots of things that fall in that area of derivatives. But derivatives, the thing we need to understand about it is the further you get away from the center of value, the more risky or the more volatile that derivative becomes. Small changes in prices of the underlying asset has big shock waves on the outer ring. Okay.
So this just kind of comes back to that scene in the Big Short where they're all around the blackjack table and taking side bets on blackjack.
That's exactly it, right? The movement becomes bigger the further from the center of the action that you get. Okay. And that's exactly what was happening in 2008. People were making side bets upon side bets upon side bets. Okay? But this is kind of the order of risk that we want to think about how our economy operates. Okay? On the outer ring, we have investment bank activities. Okay? This is highly leveraged, highly speculative types of investing. This is where our interest default swaps and all that kind of stuff out there lives. Okay?
So these are your Goldmans
and Lehmans and yep, all of that. Okay. The next level are your commercial banks. Okay. Less risky because we're closer to the asset that's being lent against, but we're still highly leveraged, fractional reserves, and we're still not really investing in the underlying asset. It's usually still, accumulating mortgages together and selling them on a secondary market or something like that, as an example. Okay. The next inner ring are just traditional banks. Okay. Now, Jimmy, as we talked about this at the beginning, you kind of pointed out this is confusing because doesn't Citigroup do all three activities? Well, yeah, they do.
Right.
Okay. So now it used to be done by separate organizations, and now it's all together in one. And you made a really...
When an investment bank fails with the bail-ins, if you use Citigroup or Bank of America, and you use Bank of America just for its traditional functions, and they fail out of the investment bank ring, your deposits are still liable to that failure.
And that's a new risk that a lot of people aren't aware of. And that's one reason that for my traditional banking activity, I only use credit unions. Because credit unions aren't involved in the commercial or investment.
Bank liability, right?
Exactly. Yep. So it gets me away from that. So that's kind of one kind of neat takeaway. Okay. But at the center of all this, what a lot of people aren't aware of our capital markets are deepest and kind of sitting at the core, the people that really own the core true assets are actually life insurance companies. Okay? They don't participate in the other levels, and we're going to go through some of these reasons. But what we wanted, the reasons we kind of called this cockroaches,
and
Twinkies.
Also talk about how there's no fractional reserve of life insurance companies.
Yep, exactly. That's what we're going to get into. But really quickly, the reason we called this cockroaches, life insurance, or cockroaches, Twinkies, and life insurance companies, we kind of think about the things that are going to be around after the apocalypse. Cockroaches are going to survive, Twinkies are going to survive, and really life insurance companies are too. Because as the economy is affected and pressure is put on the ring, the first and most volatile thing is this investment bank on the outside. And as that collapses through, then it's going to affect the commercial bank, then it's going to affect traditional banks, and then and only then will it affect your insurance companies. Okay? And the evidence of this is 2008. Investment banks were affected, commercial banks were affected, some traditional banks were affected, but my life insurance company still paid me a dividend, which means they were still profitable. It didn't make it to them.
And at the end of the day, the way it makes sense to my brain is it's impossible to create a run on a life insurance company.
And that's exactly what I'm going to show you why that is. Yep. Okay. So Great Depression, stagflation, dot-com bubble, real estate bubble, insurance companies were profitable. It never made it to the center. And we're going to show you why. Okay. So the first reason why, Jimmy, is what you were talking about. No fractional reserves. Okay? So your money...
The more I study in Austrian economics and banking and regulatory things, it's all because of fractional reserve banking why we need the regulators. It's all why these silly rules are in place. If there was just no fractional reserve banking, these wouldn't be issues. So that's for another video.
But however, there is no option for you to put your money somewhere where there's not fractional reserves, except a life insurance company. They're the only pseudo entity, or whatever you want to call it, that does not fractionally reserve. Okay? So what this means is your cash value, by law, the insurance company is required to keep 100% of that liquid. So the investments that they're doing, because these insurance companies have billion-dollar, multi-billion-dollar investment portfolios, but they cannot invest your cash. It is the equivalent of it just sitting there in cash, ready to give back to you. They can only do things and leverage and get involved with the excess above that. Does that make sense?
Yep.
Okay, so your money is there, ready to go. The second piece to this, Jimmy, what did we want to talk about?
Low time preference.
Okay, boom, that's a great one. Okay, so time preference. The after fractional, no fractional reserve, we've got a very, very low time preference. Okay, and this comes back to a couple different pieces to their time preference, but there's two things affecting this. The first thing is when you give your money to Wall Street or a bank, how quickly do they expect that transaction to be dissolved or moved or rolled over or something happened to it? Very, very short time periods, right? The average mutual fund churns their entire investment holding once a year.
Well, at the end of the day, they don't care if you're making money. They just care that their quarterly report looks good and they don't get fired.
And they want their fees up front, whether the investment pans out or not.
The more fees they collect.
Yep. Okay. So, but with an insurance company, this is a lifelong commitment that they're making to you. When they're trying to look at the best interests of their shareholders, they're realizing that they have to pay a death benefit 40 years from now. So all of their decisions are made with that long time horizon in mind. That horizon is built into their investment models. They have to make decisions that allow for that capital to still be there and pay you that death benefit in the future. Okay? Where no other institution has that commitment to you.
And that's what makes me very nervous about Wall Street, because I used to work for a publicly traded company, and even on the small level that I was at, it was all about answering to Wall Street, and it was all about getting the quarterly reports to look right.
Yep, exactly. So that's the second point here is there's no public quarterly report earnings to meet with the insurance companies that we deal with. Okay, those the privately held insurance companies are the ones we want to deal with, so there isn't that pressure. Okay.
So a Wall Street company will increase their long-term risk because they have a high time preference to make their short-term gain look correct.
Exactly. Yep. And they will sacrifice they'll move money to this quarter, not caring what happens the next year. They've got to hit this quarter, and they'll figure out next quarter. Okay.
Right.
Where the insurance company wants to say, no, I've got to figure out the long term first, and then we'll back into what we're going to do today to make sure that happens.
Yep.
Okay. The third thing is how they invest. Okay. They are the only companies that actually follow the advice that we're told every day. Okay. Warren Buffett, everybody thinks he made his money in the market, and that's baloney. He didn't. But he followed a core tenet that when he made an investment, how big did he go with that investment? He bought a controlling interest in the company that he was investing in, right?
Right.
So that he could influence the outcome. The insurance company does the same thing. They're not going to a Fidelity advisor with $1 billion investment portfolio and saying, where should I invest? Right?
Well, they're not buying retail like you and me.
Bingo. They're not buying retail. They are negotiating the terms of the investment. Okay? So whether it's they actually hold investments in companies. Okay? They own and hold investments in real estate, and they own investment in bonds. But in all three cases, they are controlling the offering because they're bringing hundreds of millions of dollars to the table. Okay?
Right.
And then the second piece to this is we're told this by guys like Kiyosaki all the time, but they only invest for cash flow. That's all that they really care about. They understand that they can't control a future valuation of something. So if they're going to make an investment, it's going to yield a cash flow. And then that cash flow is what they build their future projections on. So the market...
They realize gains every month. They don't care about it. They can't afford to have an unrealized gain.
Exactly, because they've got to be there for 40 years. Think about... So I started investing in real estate in 2005. And everybody sort of covers their ears and says, oh, how did 07 go for you? I was like, yeah, it was bumpy, but I just sat back and collected rent checks all day long. I didn't care that the market value of my property fell 40% because I invested for cash flow and I collected cash month in and month out. And I was able to sustain through that. Insurance companies are the same way. Everybody sort of cringes looking that 80% of the average insurance company is invested in bonds. People are like, oh, the bond market's going to blow up. Yeah, that might be true, but the insurance company is going to react to the same way that seasoned real estate investors acted when the bottom fell out of the real estate market. What did seasoned real estate investors do when the bottom fell out?
They bought.
They bought as much as they could because for the same monthly rent of $1,000, they could now pay $120,000 instead of $150,000. That was an awesome deal. And there's insurance companies are going to do the same thing. When the bond market falls, the cash flow on those bonds is going to stay the same. It's the market value that's going to take a hit as yields go up. Okay, that's confusing. That may be another time. But
yeah, and as I'm reading this, the most important thing to me is what do they invest for? Control and cash flow. What's the main asset class where you can get that?
Bonds and real estate.
And real estate.
And those are the two largest assets. And bonds... The reason bonds, let's back up for a second. The reason bonds carry so much control is there's two ways you can typically invest in a company. Debt or equity.
If you control with bonds, you're not controlling how that company's doing.
But you're in first position on their cash flow. Because there's two ways you can invest in a company. Debt or equity, right? Yeah. And who gets paid first? Debt.
Yeah.
Then equity. Okay, but the rest of the world, or the rest of the investors are typically told, invest for equity. But you are the lowest man on the totem pole. So insurance companies don't often invest for equity. They would prefer to invest for debt and get paid first. So they may not be able to make decisions for the company, but they are, when there is cash flow, they are the first ones with claim to that cash flow. Does that make sense?
That's a good point. Yeah.
So they like debt for that reason. Okay. And you at Joint Ops, you try to tell investors all the time, in some regards, it's better to lend to us rather than directly own and have the equity because there's risk on the equity side, but we're going to guarantee some cash flow on the lending side, right?
Right. You just want to sleep at night and just invest.
Exactly. Go for debt, okay? And that's what insurance companies, that's why 80% of their money's in debt, because they want to sleep at night. And they want their...
Okay, here's the other thing to bring it back to real estate. what are all these outer rings at the end of the day? Probably investing a significant amount of money in.
What?
Real estate.
Yeah. Or a derivative of real estate, right?
Right. This is another example. Like if you give money to your traditional or commercial banks, they're then going to go give that money to someone like me investing in real estate.
Bingo.
I can't speak to the investment banks. I don't know that much about it. But if you just invest in your own life insurance policy, you get to cut out those other three rings, and you lower your risk significantly.
Yeah, it's really interesting because just a couple blocks from my office here in downtown Salt Lake, the state of Utah built a county courthouse. So it's a big, beautiful building. But guess who financed that?
Insurance company.
The bulk of it was an insurance company. So guess who got the benefit of that financing project of a state-owned building who had very low likelihood of default? An insurance company. And those that, because there was some outside, investment banking, commercial bank money involved, but the bulk of those types of projects are funded by life insurance companies because they have the deepest, most liquid pockets. So they bring 80% of the capital and allow traditional commercial banks to take the other portion. So if you're investing with these guys, you're getting second and third dibs on what the insurance company is filling up on first.
Right.
Okay.
Well, I'm sold. I hope everybody watching this video is sold. If not, we'll keep producing videos until you're sold.
We will beat you over the head with it until you are. Cool. Thanks for having me on. Like I said, we'll beat you over the head until you get this. But yeah, this is another great example of why we center your investing world in something like a life insurance company, and then we leverage it out into what you can actively produce income on, something like real estate.
I love it.
Awesome.
Thanks, buddy.
Till next time.